This is a joint work with Yannis Bakos, and as I'm going to be talking about it, we have a series of papers. So this is why it's good to keep in mind his name. So this one is, unsurprisingly, session, another paper on tokens and on funding the new ventures. So this is another slide to motivate that ICOs were very much a very prominent activity in 2017, 2018. We don't hear about them as much in 2019, but there are nonetheless still the activity is going on. Maybe not as much in terms of value, but the number of ICOs is quite strong. In terms of value, is an interesting side note. The valuation of ICOs were very often measured through Bitcoin, because often ICOs would be bought, the tokens would be bought with Bitcoin or Ethereum, and as the price of Bitcoin was increasing rapidly, then the valuation of ICOs was high. But still, like, even if we keep this in mind, there's a lot of activity. So as a few people mentioned by now, a lot of the activity is related, or we think about ICO activity in terms of hype and fraud and bubbles and crashes. And if I ask my students what do they think the ICOs are good for, the number one answer, most often answer that I hear, is to get around regulation. And it is very much true currently. But what Yannis and I will explore in few papers is, are there a question whether there are legitimate reasons to issue tokens? And I mean, as you have heard in a couple of presentations now, there's not only us two, but number of other people also discovering or trying to define valuable aspects of tokens, or valuable functionalities of tokens. So in a previous paper, in the other paper that we are still working on, we look at the role of tokens in coordinating demand in environments with network effects. In this paper, however, we are looking at a specific role of tokens as discovering demand. So in a situation that an entrepreneur starts a new venture, wants to sell a product or a service, may not fully know what is the demand for the product, crowdsourcing this information from the market may be a better option than using the funds directly. And we already have a tool for crowdsourcing of information about the market demand, and this is crowdfunding. This is like platforms like Kickstarter. So this paper will look very directly at the relative advantage of ICOs, or lack of thereof, of ICOs over Kickstarter, in addition to looking at just directly funding with VC money. So we focus here on estimating the potential demand, and even though we have due diligence in the title, we do plan to expand it in the future, but we abstract currently from other very important considerations that typically are included in due diligence. So this is a very narrowly understood due diligence about the market conditions. We do not worry about the moral hazard problem that was discussed in previous papers. So we think that if the entrepreneur is going to get the funding for starting the venture, there will be no problem with effort or with an entrepreneur taking money and running off to Bahamas. There's also no risk of technology or skills of the entrepreneur, because they may put in the effort and they may be good-willed, but as we do look at the enterprises and white papers of ICOs, the skill may not necessarily be there, or even ability of technology. So we are going to abstract from this, also from other considerations, and they are very valid points that we plan to extend this paper later on and discuss how they would affect the results. But right now we just focus on the potential demand. So what we have in this in the environment that we are considering is an entrepreneur who needs to raise some C to be able to develop the product. We will say that there is no other cost later on. We take very simple environment, and that the product or service as it will be developed, there will be no competition. It's a completely new thing. This is why we need to estimate the market, and we may not have enough information about the market. Right? The demand is going to be characterized by parameter theta that will be in the basic model unknown. Benchmark will be known, and we are going to look at the effect or the importance of uncertainty on how valuable tokens are in discovering theta. Right? The entrepreneur has three ways to finance C. Either there are no tradable claims, so this would be the traditional Kickstarter, or a tradable tokens. So the distinction that we want to draw here is that if you are pre-buying some items on Kickstarter, so you are buying claims for the product once it will be developed. In theory, you could basically buy more of these products if you think that this product will be very popular, and you can later resell those products on eBay. But this is generally quite costly. So we're going to assume that for the Kickstarter version, this is costly enough that it's prohibitively costly. People just buy for their own consumption. Whereas tradable tokens make it very easy to trade those claims for future products. So you are buying the product now, so we are looking at utility tokens. So you are buying the claim to the product that you can very easily trade later on. That's the main distinction. And it can, yes?
It means the only output of the token is the consuming the service and being burned?
Yes. Yes, so there will be an exchange, but you have the token, and you can either claim the product or you can trade your token, and whoever bought the token can claim the product. But there is, you can only trade it as long as you don't claim the product, or you eventually use the token and then you don't have it anymore and you cannot trade it. And in theory, this is what utility tokens are, that you should be using them, and once you use them, you don't have anything to trade anymore. Just currently, we don't have an example, or not many examples, where you can actually use the utility tokens. So this is why there aren't so much utility tokens, and we think about the value from trading them. So here specifically, we say, look, there are a lot of different dimensions of tokens, and right now we mostly trade them, even though the white papers claim that they will be utility tokens, so not to fall under the regulation, securities regulation. And there may be different values, a lot of value from tokens from different functionality. So we want to put apart, the kind of tear apart different functionalities of tokens and to look at each functionality separately and ask what value does it have. Because right now we are in a very early stage of the market, and the tokens as we have them now may morph into something different, and they may keep some of the attributes and some of the functionality, and may completely disregard others. So for example, right now we mostly think about tokens in context of blockchain, and they have the easy tradability feature, and maybe there are claims on future revenues. We don't know that. For example, we also know that tokens do not need blockchain, but I think we think that tradability is this really very tokeny feature, that this is the essence of tokens. So we are asking, what is the value of having tradability in the market, for example, for crowdfunding? So if you are on the Kickstarter and you can choose whether to just pre-sell your product or pre-sell an easily tradable token for your product, which one would you choose? Here, blockchain is not going to have any bite. Okay? The third version, a third possibility of financing C is venture capital. And venture capital, as we have it now, is kind of aspirational because we started with the very simple version of venture capital, and I feel obliged to explain it given the discussion on the finance side that we had. So we said, let's take the most optimistic version, most profitable venture capital. So basically, you go to your uncle, and your uncle is not charging you anything for the money he lends you. Okay, so this is and that's it. There's no cost of capital. You don't give up any equity. You basically go and get money from somebody else, and we make, like, you can tell a story. Alternatively, you can think about it currently as the entrepreneur just self-financing the product. And it may still turn out that sometimes tokens are better and sometimes tokens are worse. So we thought that it is already interesting, and of course we are going to add the cost of capital, but we think that the results are going to move in a very predictable direction. Okay? So to preview the results, as I already kind of started, when there is no demand uncertainty, everybody can see data, the demand. The tradable tokens are dominated by crowdfunding and by self-financing or VC. And there are two dimensions in which we are going to care about the financing and the relative value of financing. One is in terms of, with different financing, the entrepreneur can achieve different revenue. And here, because there is no marginal cost, revenue is equivalent to profit, or at least relatively. Higher revenue means higher profit. So both VC funding and crowdfunding commitment are going to give the entrepreneur higher revenue than tokens, and with demand certainty. And venture capital is going to also allow to fund larger projects. So tokens are dominated on both dimensions. However, as demand uncertainty increases, tradable tokens become more attractive. But they become more attractive only on one dimension. They allowed to fund larger projects. So they always allow to fund larger projects than crowdfunding. But as the demand uncertainty increases, they allow to fund larger projects than VC funding, or even if it's self-funding. Yet they still yield lower expected profit if we look at the project that would be funded both by VC and by tokens, and could be funded by tokens, then for those projects, the revenue from funding through VC are going to be higher. Again, we are assuming no cost of capital, so of course, if you add cost of capital, then it's going to be maybe lower. But there is no really interaction with this cost of capital. So how are we going to get to these results? Is we have a very simple model. The market is populated by mass data of potential buyers, and this data may be unknown. And each potential buyer has a unit demand, so will only want to consume one product, with valuation drawn from 0 to 1, uniform distribution. This gives us a very nice demand function, a very not even similar, exactly the same demand function as Andreas showed us before. We have two periods here. And in the first period, we have potential buyers. We have early adopters as potential buyers. In the second period, everyone is present. So every buyer is an early adopter with probability X, which is less than 1/2. And those early adopters are present in the market in the first period. The general market, others who are not early adopters, they show up to the market only in the second period. So to think about it, again, in categories either of ICO or even crowdfunding like Kickstarter, there are people who monitor those early developers. They are interested in what is the new thing on Kickstarter, or they look at the opportunities at ICOs, and they may get more information, but they may like or may not like the product. So just because they are early adopters does not mean that they have higher valuation. It just means that they are paying attention to the market. And then once the product will be developed, if the product will be developed, the product will be developed only in period 2. And at that time, everyone can see what this product is, and they may decide whether they like it or not. So this X is going to play a role if we're thinking about the funding possibilities, especially for the crowdfunding. Okay. We also make a very simplifying assumption on risk attitudes. And again, this is something to be added and commented later on. Everybody is risk neutral, and there is no discounting. Everybody is patient. So our results will not be driven by these factors. So entrepreneur can choose either to pre-sell and the pre-sale may be tradable or not. And if the entrepreneur goes with a pre-sale, entrepreneur decides how many of items to pre-sell in the first period. So whether how many tokens to issue in the first period or how many pre-sales to offer on Kickstarter. And then the market is going to clear at some price P1. So if the entrepreneur knows the data, then doesn't matter which one this is set. But if the entrepreneur does not know data, it only sets Q1 and then learns what is the price at which the market demands that many items. If the revenue achieved in the first period is larger than the development cost, and the product is developed. Again, we assume no moral hazard. This is explored in other papers. And the product is developed to the market in period 2. At period 2, the pre-sales are, so if it's a pre-sale, then the people who pre-bought can claim the product. People who have tokens, they can either sell their tokens, or whoever has the token, whether they bought it in period 1 or period 2, they can claim a product for the token. And whatever is still unfulfilled demand outside of this Q1, then the entrepreneur can offer additional quantity Q2, which will clear at market price P2. But in the second period, the demand is perfectly known. So again, the optimization is very clear. Now, if the revenue is below C, it's another kind of important and simplifying assumption, is that if the entrepreneur does not manage to raise enough funds, then all the pre-sales are refunded. So this is this means that there is no uncertainty for the crowds when they buy tokens or the pre-sales. And this is right now not very realistic in terms of tokens, but it is practiced by Kickstarter and crowdfunding platforms, where the funds are held in escrow, and in case not enough funds is raised, then they are released back to the investors. And we could imagine something like that applied to tokens. So that's not completely unreasonable, but not happening right now. So it's future vision. With investor funding, the entrepreneur gets money before period 1. It quickly turns out that there is no point for pre-sales if there is money coming from the investor. So that's basically it. Entrepreneur gets the money, and then in period 2, when the demand is revealed, the product is produced at the optimal monopoly price. Okay? So let's suppose that data is known to everyone. In crowdfunding, the entrepreneur sets Q1, resulting in P1, and it is important that now that the demand is fully known, the expected price P2 has to be higher than the price P1, because otherwise nobody buys in the first period and entrepreneurs cannot produce the product. Right? So the seller can either commit or not commit to a lower price to a higher price in the second period. And if the seller can commit, then sets the monopoly price in both periods and collects the revenue that is depending on the fraction of early adopters. So the highest C that the entrepreneur can set depends on the fraction of the market that is present in the first period. Now, if the seller cannot commit, and I'm not going to get into this detail, but the seller has to set higher Q1 that is monopoly optimizing, and this is kind of relevant, the logic is relevant to what Andreas was saying, but to some extent. This is basically, if the entrepreneur sets monopoly price in the first period, that in the second period there's always incentive to lower the price below monopoly price, and knowing that nobody will want to buy at monopoly price in the first period. So therefore there needs to be larger number of items supply at the lower price, which is at a big loss. But we are going to focus mostly on the commitment case because it is the best case for the entrepreneur. With tradable tokens, the demand of tradable tokens, in a way, the entrepreneur cannot commit to a higher price in the second period, because the price will, in large case, depend on the demand in the second period. Demand will depend on the number of tokens in the first period. And it turns out, so you can see from the formula, the price in the second period will be lower the higher number of tokens are sold in the first period. And in fact, the price can be fully predicted in the second period, and the buyers of the users in the first period are going to be will be willing to pay up to this price, up to the same price in the first period, because they know that in the second period, given this market price, they will be able to sell. So no matter what is their own utility, they will buy depending on what they expect the market to do in the second period. So speculation. That means that there will be much higher demand for the tokens in the first period than in case of crowdfunding, where buyers can only buy for their own use. Okay? The entrepreneur profit is always going down with the number of tokens. The more tokens are issued, the lower is the profit. But the more tokens are issued, the higher is the upfront cost that the entrepreneur can cover. So this is the main trade-off. The more the entrepreneur is going to raise, the lower overall profit will be with using tokens. Okay. But the tokens always allow to collect higher funds upfront than crowdfunding at lower overall revenues. Okay. So funding from investors is easy. It always offers monopoly pricing. So this is why funding from VC investors or self-funding offers monopolistic revenue. So I'm going to skip the results that I have already said, and I want to quickly focus on uncertain demand. So when agents do not know data, the VCs and entrepreneur have just some expectations, some prior about possible demand that is between A and B, uniformly distributed, and maybe wider or narrower. But the buyers know their own demand. They know they know their own valuation, and they treat it as a signal about the rest of the market. And from that, what we can find is that the funding is attractive only if uncertainty is low. But tokens are more attractive when uncertainty is high. They still yield lower expected profits, but they allow to fund more expensive projects. And it basically comes that now that I have 30 seconds, I'm going to give mainly the intuition that it basically comes from the fact that if you go to the market, you are going to learn about demand, and you are going to fund projects that are worth funding, because you are going to learn from the source whether there is a demand for the project or not. If you go for either self-funding or VC funding, you are bearing higher risk of going after the project that you think in expectation is okay, but may turn out to be higher. As the expectations are as the support is increasing and the demand is more uncertain, you don't want to take too much risk of going after after risky projects, whereas relative value of the token, so actually learning from the market what the demand is and going only after projects that are worthwhile is much more valuable. So VC is going to fund smaller projects, tokens are going to fund increasingly more demanding projects, but the overall profits for the entrepreneur are going to be lower because the more tokens are sold in the beginning, the lower is the price in the beginning and the lower is the price in the second period as well. Moreover, if the demand, realized demand is the higher is the realized demand, the more the entrepreneur forgoes the profits by having token sales, which is kind of a side result. So thank you very much. Yep.
So could you please clarify why did you say that the crowdfunding type model, when a certain threshold is not reached, then all the funds are refunded, is not used in practice? I mean, on the blockchain, it happens all the time. It's actually a very popular scheme.
Oh, really? Okay, so crowdfunding for sure is happening, but
token-based crowdfunding is also happening. There was like in the early 2018, there were some concerns about exchange rate risk. So basically, when you collect a lot of tokens, then your ICO fails, and then you give the same tokens back. It's not the same value. But now that there are stable coins which are smart contract friendly, for example, DAI, that's one of its most popular uses actually, to hold ICO funds and shield ICOs from exchange rate risk. That is standard practice.
That's
Happens
great.
all the time.
That's great. Thank you.
I thought you were talking about the final development.
Final development. Yeah. So if there is no risk for final development in our model. Okay. So basically, if you collect enough funds, then I guess we need to take from previous papers that discuss the development risk or moral hazard risk, but we do not take this here. It's just about learning demand. Okay. Thank you.